On Sunday, March 19th, the president of Switzerland hosted a press conference with the chairman of UBS and Credit Suisse to announce the merger of the two banks that his government had rushed to arrange before markets opened on Monday. The Swiss government invoked emergency powers to merge the two banks without shareholder votes from either side. You can think of this as a financial equivalent of martial law. Founded in 1856, Credit Suisse has been one of Europe's most well-respected financial institutions. The company's previously proud history has become tarnished in recent years after repeated scandals and risk management failures, which have caused its market cap to decline from a peak of $80 billion in 2008 to around $9 billion by the beginning of 2023. In March of this year, banking failures in the US caused a confidence crisis in the global banking industry. This caused a bank run at Credit Suisse, with depositors withdrawing their funds hand over fist. With their cash position deteriorating rapidly, the once proud Swiss institution was forced to accept a humiliating deal to be acquired by their arch-rival UBS for the equivalent of $3.2 billion. This situation has been a complete catastrophe for Credit Suisse's shareholders, as this represents a 60% discount to the stock's trading price as of the previous Friday, and a more than 90% discount to the bank's tangible book value. In addition to buying their rival for such a discount, the Swiss central bank is also giving UBS a 100 billion franc loan to help them meet the liquidity needs of their new combined entity. While this deal was a disaster for Credit Suisse, it could shape up to be the deal of the century for UBS. A merger between the two firms would never have been possible in normal times due to antitrust concerns. With this deal, they'll become a near monopoly within the domestic Swiss market and become one of the largest wealth managers in the world with over $5 trillion of invested assets. And not only do they not have any regulatory pushback, the central bank is supporting this deal with a 100 billion franc subsidized loan. In this video, we'll take a look at how UBS stands to benefit tremendously from the current banking crisis, and what this means for the global financial system. In October of 2022, Saudi National Bank, the largest bank in Saudi Arabia, bought a 10% stake in Credit Suisse for $1.5 billion. With the disastrous UBS merger, their investment is now worth just $300 million, making it a near total loss. The only thing worse than losing $1 billion in 5 months is buying a brand new pair of shoes and stepping in a muddy puddle that ruins them on your first day. But this is an issue you won't have to worry about with today's sponsor Vessi, a company that makes stylish, functional, multi-purpose, and most importantly waterproof shoes. Vessi's proprietary Dymatex technology is 100% waterproof, not water resistant. To make sure they lived up to what they advertised, I put them on and sprayed them non-stop with a garden hose, and sure enough, my socks were bone dry. When you think of waterproof shoes, you generally think of rubber boots, but thanks to Vessi's Dymatex material, these shoes are completely breathable, and they also adapt to the surrounding temperature. So in the winter, they'll keep your feet warm, while in the summer, it'll help keep them cool. So if you've ever had to deal with wet socks on a rainy day and didn't like the experience, I would highly recommend checking them out. You can use the URL vessi.com/WSM to get 15% off any shoe styles they offer, all of them being 100% waterproof. Headquartered in Zurich, Switzerland, UBS is a global commercial bank that in a lot of ways is very similar to Credit Suisse. In fact, the two banks' headquarters are located right across the street from each other. They operate in the same 4 segments: wealth management, personal and corporate banking, asset management, and investment banking. Credit Suisse's Swiss bank segment is roughly analogous to UBS's personal and corporate banking segment. For both Credit Suisse and UBS, wealth management is their most important segment. This is because Switzerland's banking secrecy laws makes it an ideal place for oligarchs and other wealthy people to store and manage their money without drawing scrutiny. For example, say that you're a rich businessman and you made your fortune in a corrupt country. You might want to move your money out of your home country to avoid government officials expropriating it from you. You'll need to employ the services of a wealth manager to help you set up various shell companies to own properties, yachts, and other real assets all around the world that can't easily be seized. For more than a century, Switzerland has been the place to go for these types of services, with Credit Suisse and UBS emerging as a de facto duopoly in this industry. They can also help you with more mundane services like tax planning, estate planning, and money management. Given their similar business mix, the two banks' share prices used to move almost in lockstep with each other. Whatever developments that happen in the investment banking industry would affect the two banks almost identically. But their share prices started to diverge significantly in 2021. The reason for this divergence were 2 high-profile disasters that Credit Suisse was involved in: the Greensill scandal and the Archegos collapse. If you want to learn more about Credit Suisse's scandals, you can check out these two videos that we've made about them, link in the description below. Because of these scandals, Credit Suisse had $125 billion of net outflows from their wealth management clients, while UBS had $60 billion of net inflows. While UBS has had its share of scandals, they've been far less frequent and far less severe than those at Credit Suisse. For example, UBS also lent money to Archegos, but only ended up losing $800 million from the collapse compared to Credit Suisse's $4.7 billion. Most analysts agree that UBS has a more conservative culture with better risk management controls. Credit Suisse was more aggressive in trying to make as much money as possible, which led them to cutting corners and making ethically questionable business decisions. One of the major challenges faced by Credit Suisse in recent years was the high turnover of its senior leadership team. During the 5-year period from 2015 to 2020, the bank was under the leadership of Tidjane Thiam, who was tasked with implementing a significant restructuring plan aimed at improving profitability and reducing costs. However, in 2018, the head of Credit Suisse's wealth management division, Iqbal Khan, left the bank to take up a new position at UBS. This perceived betrayal apparently infuriated Thiam. Fearing that Khan would take some of Credit Suisse's valuable clients with him, Thiam made the controversial decision to hire private investigators to spy on Khan. The legality of this action is subject to debate, but ultimately led to Thiam's resignation and disgrace after the scandal was uncovered. This episode not only exposed the freewheeling culture of Credit Suisse, but also revealed the intense rivalry between the two largest Swiss banks. Because they serve the same markets with the same services, Credit Suisse and UBS compete for the same clients and hire from the same pool of Swiss bankers. This creates constant competitive tension between them. Of course, now that the two banks have merged into one, this competitive tension has been completely ameliorated in UBS's favor. UBS paid 3 billion francs to acquire Credit Suisse in an all-stock transaction. Given that UBS's market cap is about 56 billion francs, this purchase price is minuscule. So what will the combined company look like? In 2022, UBS did pretty well, making $34 billion of revenue, which was roughly flat versus the prior year. After subtracting operating expenses, they made almost $10 billion of operating profit. Credit Suisse's financials were a different story. They made $16 billion of revenue, which represents an almost 30% decline from the prior year. This was due to declining revenues in their investment banking and wealth management divisions as clients withdrew their money. The sharp decline in revenue led to a $3.5 billion operating loss. However, the Credit Suisse loss includes almost $2 billion of litigation and restructuring expenses. If you adjust for these, their operating loss would have been $1.5 billion. It's possible that there will be more litigation expenses down the road, but once UBS takes control and implements stricter internal controls, these expenses should decrease substantially, if not altogether. Also, before 2021, Credit Suisse was highly profitable. They've just come under a great deal of pressure over the past 2 years. Credit Suisse has a huge network of wealth advisors who have close relationships with high net worth clients around the world. These clients left the bank in droves because they feared for its solvency. Now that Credit Suisse has UBS's balance sheet and risk management team backing it up, a lot of them will come back. And we know how important client relationships are from the 2018 spying scandal. But the ability to lure back wealth management clients may not even be the most lucrative part of the merger. According to UBS, they expect to reduce $8 billion of costs over the coming years. Credit Suisse had already planned to lay off 9,000 staff as part of its restructuring last year. These layoffs will accelerate as a result of the merger. Whenever two companies merge, there is almost always some room to lay off redundant workers who have overlapping responsibilities. For example, both banks employ thousands of salespeople who reach out to prospective clients. It wouldn't be uncommon for a high net worth individual to be contacted by both a UBS and Credit Suisse salesperson. Now, the combined bank just has to send out one salesperson to each prospective client, so the total number of salespeople needed will be lower. In addition to laying off redundant workers, UBS plans to dramatically scale down Credit Suisse's investment banking operations. It will reduce investment banking revenue, but given that this division was losing money anyway, the benefit of axing the highly paid investment bankers should outweigh the revenue decline. Another benefit of mass layoffs is that you can selectively choose to keep only the best performing employees, and the ones that remain will be hyper motivated to increase their productivity to avoid being laid off themselves. The final benefit of the merger will be its anti-competitive nature within the domestic Swiss market. The combined entity will be the largest bank in Switzerland by far, giving it tremendous market power. That's why such a merger would never have been allowed in normal times. Less competition means the combined bank can offer lower savings rates on deposits and higher interest rates on its loans. By using some reasonable assumptions, we can see how this deal has the potential to be massively beneficial to UBS. We start off with UBS's standalone 2022 operating profit of $9.6 billion. We subtract the $3.5 billion standalone loss from Credit Suisse. We add back $2 billion of litigation and restructuring expenses, which are non-recurring. We add $8 billion of cost cuts. We add $1 billion from some of Credit Suisse's wealth management clients coming back. Credit Suisse's wealth management profits declined by more than $2 billion in 2022, so less than half of them will have to come back to achieve this target. And finally, we subtract $2 billion of revenue from the investment banking division, which UBS will be scaling down. All of this together takes UBS's operating profit up to $15 billion, a 50% increase from what they had as a standalone company. Of course, this will take a few years to achieve, and there will be significant restructuring and employee severance costs in between. But it's pretty easy to see how UBS got a steal in buying Credit Suisse for just $3 billion. In the aftermath of the 2008 global financial crisis, the concept of too big to fail has become a major concern. Governments had to intervene and put taxpayers' money at risk to bail out failing banks and insurance companies. With the recent acquisition of Credit Suisse by UBS, the new entity is now even larger and more complex than before, making it a prime example of a bank that is too big to fail. While the chances of UBS going bankrupt in the foreseeable future seem remote, if you go back just 2 years, you could have said the same thing about Credit Suisse. Switzerland, as one of the world's wealthiest nations, has built its economic success on its dominance in the global finance industry. With UBS now being the only major bank in the country, its collapse would have catastrophic consequences that Switzerland may never recover from. UBS's acquisition of Credit Suisse underscores the fact that UBS enjoys implicit government support, even in the absence of an explicit guarantee. This guarantee can help prevent a confidence crisis and bank run on UBS, which is what caused Credit Suisse's collapse. Therefore, the implicit guarantee of unlimited government support for UBS may be the most valuable asset of all. This guarantee can instill confidence in depositors and investors, preventing the need for a costly government bailout in the future. In addition to all the cost-cutting benefits that we mentioned earlier, the implicit guarantee that UBS can never fail may be the most valuable asset of all. Alright guys, that wraps it up for this video. What do you think about the UBS-Credit Suisse merger? Let us know in the comments section below. As always, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.